Hey everybody, and welcome back to Eggs. Today's special guest is founder of Insight Tax and Accounting and the author of Profit First for Microgyms, John Briggs. John's accounting firm has more gyms for clients than any other firm in the country, not to mention thousands of other client-driven businesses. Through this vast experience, he has learned that achieving a highly profitable business can be overwhelming, particularly with all the barriers and uncertainties that a new owner could be forced to deal with. He's found that this can lead quickly to stress and burnout, and many will abandon their dreams of business ownership altogether. This is where John steps in. On a personal mission to help entrepreneurs avoid burnout, John helps them discover work-life balance and shows them how to increase their cash flow immediately so that they have more confidence in their choices and ultimately become financially resilient. Joining us today for a discussion about choosing the right tax structure to save thousands on taxes, cash flow management, how and when to scale and grow your business, and so much more. Please join us in welcoming to the show, John Briggs. Hey, John, how are you? Welcome to the show.
I'm good. Thanks for having me.
Absolutely. Thrilled to do it. So if we can maybe just kind of start at the beginning with you, and let's lay a little bit of fundamental sort of background information out there and just let our audience know who you are, where you're from, and what you do.
Okay. So I'm in Utah, married, 4 kids, and I'm an owner of an accounting firm. We have 37 team members currently, and we really, there's a whole slew of things we do, but we think the government sucks at spending people's money. So we really like to help them keep our clients keep as much money as possible. We also know that most people don't go into business to be accountants. So we like to support them with things so they can keep as much of their cash as possible and grow their wealth. So that's a little about what I'm doing now.
Yeah. So, let's talk a little too, also just sort of about your background and how you got into accounting in the first place.
Yeah. Okay. I have a master's degree in tax from BYU. And one of the things that they teach you, like a lot of universities, is how to become a cog in the wheel of a bigger accounting firm. And so that was kind of my mindset. But through connections I had through, at the time, my fiance, who's now my wife, I ended up taking a job as a controller for a door-to-door sales company. That is such an interesting industry. This company, I'll just fast forward to the punchline. The company did $30 million in revenue the same year it declared bankruptcy and closed its doors. Close to 30 million in revenue. So there's some lessons there that I definitely learned. Through that though, after that experience, I'm like, look, I got a master's in tax. I had spent some time at Deloitte. I better go back into the tax world. And so I did. And I was at a smaller firm and very family run, nepotistic company, went off on my own, then realized I had to get a CPA. I had to have CPAs supervise my work to officially get my license, even though I'd passed the test. So I joined another firm, and then that was run by a narcissist. And so then I decided, you know what? I think at this point, I'm just going to create my own firm. And from that day forward, which was, 2010-ish, I've been growing Insight Tax, and it's been a good ride.
Yeah, I totally relate with working with the narcissist. I've done it before. I was looking over your what?
Said, hey, now what are you trying to say?
I still work with one. I was looking over your website, and I really enjoyed the video, the very first video that you have there, and I agree with. I don't really want the government spending $80 million on an Iron Man suit or funding study on gambling monkeys. So that's a really good video. Thank you for sharing that with me. I had a good chuckle with that. Can you maybe break down, who your optimal client is, how you got into working with microgyms, and
sure. So I have to give credit to the book that inspired me. It's called The Pumpkin Plan by Mike Michalowicz. And in the book, he actually found that the way prize-winning pumpkin farmers grow the giant 1,000-pound pumpkins is a great analogy for businesses when it comes to finding a niche that works for them. Because ultimately, the giant pumpkin is the niche. And the pumpkin farmer goes in and they pluck off a bunch of the smaller pumpkins really in the beginning. And then after another week, they pluck off everything else that doesn't look like it's growing as fast. So they've identified this is the pumpkin that seems to be taking all the nutrients. They want all the nutrients to go into the one pumpkin, and then you weed like crazy. And so I read that book, and Mike always provides a whole bunch of actionable steps. And so I went through his steps. I'm like, well, what's our big pumpkin and how do we weed through that? And we identified, you know what, we have a decent amount of gym clients at the time, and we loved working with them. No offense to doctors or lawyers out there, but a lot of times highly educated professionals also think they know as much as you do about the tax code. So they can be frustrating to work with sometimes, where gym owners are like, I know I don't know. You just tell me what to do, I'll do it. And so by identifying that, we then decided to focus our marketing, a lot of our marketing efforts on gym owners. And then the epiphany moment happened for me. I was at this gathering of a bunch of CrossFit owners. And as part of the gathering, I don't know if you guys are familiar with CrossFit, but they love exercise. And so, of course, as part of the planned programming, they all did a group workout together. And I'd never witnessed a CrossFit workout before. I felt like I was in a car accident. I'm like, I mean, I know at one point we rolled, I was upside down for a little bit, but ultimately I have no idea what the heck happened. I mean, these guys were deadlifting these crazy amount of weights and doing what they call toes to bar movements. I'm like, I don't even understand what you guys are doing. I realized at that moment, I don't think I had a full understanding of the gym owner. And so I decided that I should, one, join a CrossFit gym and kind of experience that. But then that eventually led to becoming an owner in the gym that I went to. So I became an owner just so that I could understand what they went through a little bit better, which for me was really helpful, because it's one thing to look at the profit and loss statement and know that successful gyms have on that usually 3 revenue streams. And that's not to say you can't be successful with just one, but typically it's like they have group training, they have personal training, they have nutrition. It's like a 3-legged stool. And it's easy for us to say, this is the data. But now that I've lived that and tried to implement 3 successful revenue streams in the gym, I know the headaches that could happen. I know that I know where the coaches might push back on the owner. And anyways, through this process, I ended up writing a book, Profit First for Micro Gyms, which talks about a cash flow method specifically geared towards the gym owner perspective. And yeah, at this point we have, 400 plus gym owners. Yeah, hopefully that answers your question, how we got kind of into the gym world.
Is that the only clients you work with now, or do you take other clients as well?
No, gyms probably represent 20% of our total business. A lot, I know we all want to feel like we're special and unique, but the truth is, for service-based companies, you're about 95% the same as all other service-based companies, at least from the lens of the tax code and cash flow management. And so that's primarily our niche. We don't do a lot of manufacturing clients when they have inventory and, sourcing things. We don't have a ton of that, but service-based companies, yeah, that's probably the other 80%.
Okay. Well, obviously we have a lot of people in our audience who are that type of business owner, a small business owner of a service business. And so I wonder if you could talk about, especially given that most of them, are at least the same sort of in the eyes of the tax man. Can we maybe begin our conversation with a little bit about the sort of the structure and choosing a structure? I know for a lot of, especially small, just people getting started, there's kind of so much time they spend just as a sole proprietor, or maybe they don't register anything at all. And then, everybody hears the news or hears the word about, LLCs being the big thing, or corporations or whatever. And so can we talk a little bit about the sort of the advantages of what, a small service business ought to be doing?
Totally. And this is the lowest hanging fruit for a lot of small business owners as far as easy change, massive tax impact on either side. So you have corporations. There's a C Corp, which, think of the Fortune 100 companies. For most small businesses, that is a terrible idea. Then you have the LLCs. Well, here's the great thing about LLCs is the tax code actually says LLCs don't exist to us. Those are state classifications that you set up with your state, but As far as we're concerned, we're going to force you to tax it like something that already exists in our tax code. And so that could be a sole proprietor. An LLC could be taxed like a sole proprietor. It could be taxed like a single member LLC. It could be taxed as a partnership. You could even make an election to tax it like a C corporation. But the winner for most people, and of course I have to disclose, you should always talk to someone about your specific situation. The S corporation for most small business owner is the best play for them. Now, let me clarify, because this is where it gets really confusing. LLCs are state entities. An S corporation is a tax status. You can't actually go to your state and say, I want to set up an S corp. You either set up a corporation or an LLC, and then in either case, you then send a form off to the IRS that says, please treat me like an S corporation. Any competent accountant should be able to help you walk through that process, and it should be a very small nominal fee that they charge you. I've seen some sharks out there that charge a ridiculous amount of money to file 2 pages with the IRS. But so that being said, the reason the entity classification is important is because of self-employment income. The tax code defines self-employment income as something that you have to pay self-employment tax on, which currently is 15.3%. And since most election cycles run on some sort of tax promise, that percentage could change at any point, especially with inflation and the crazy government spending that happened over COVID. Like, who knows what's going to happen when it comes to that. But so if I'm a sole proprietor, let's say I make 100 grand, just because I'm a sole proprietor, I automatically have an additional $15,000 of self-employment tax on top of my income tax rate. If I run that $100,000 through an S corporation, my net income, I don't pay the $15,000 self-employment tax. My income tax will be the same, but I can minimize a gigantic chunk of the self-employment tax portion. Now, I simplified that for a little bit. I mean, I can geek out on this stuff, but that's the general reason why entity, choosing the right classification, is super important. Same business, same expenses, sole proprietor is going to pay a lot more in tax than the person who has that as an S corp.
Okay. Well, can I just pile on that a little bit? So in my situation, right, my company is an LLC, taxed as an S corp, exactly as you described. I got that advice pretty early in my business, but I wonder if you'd talk a little bit about, or maybe you have a perspective on when is the right time to get into that? Because I'll tell you, for me, basically as a one-man shop, LLC taxes and S corp, I mean, we were on the grow, and we're doing much better these days. But I was doing this maybe 10 years ago, and our business was much smaller. And all of a sudden, you pick up all these extra bills. You've got to do payroll. You've got to have a CPA. You've got to have a bookkeeper. You got to have all this stuff, right? And maybe somebody who's better with all that than me could do it without hiring all those folks. But for me, I needed to hire all those people. And so what I found is yes, there was some tax savings, and in some cases, very significant tax savings. But I was paying everybody and having to hire all these new people that maybe could have been a better time to start doing that. Do you have any thoughts on that?
I do. So I will also say this: if you ask one question to 10 CPAs, you'll get 15 different answers. So this is my answer based on my experience. I, of course, think very highly of my opinion. I've heard some CPAs say $100,000 is the number, which is ludicrous to me. Really what you're comparing is, what is the tax savings I get compared to the additional cost I have to take on? Because to your point, having an S corp is more complicated than having just an LLC that's filing on your personal tax return as a sole proprietor. And so what costs am I going to incur? You have to run a payroll for yourself. It's IRS compliance rules. So there's some payroll fees, because you'd want a professional to do that, since if you get caught with payroll stuff, the penalties are ludicrous. They can charge up to 100% of your payroll tax and penalties. Oh, wow. So you don't want to screw up on that. So better to pay a professional. It's a separate business return, so that's an additional fee. Okay. So if I look at the additional fees, I want to compare it to what the actual tax savings are. And so that number might be a little bit different for everybody, but in general, We have found $10,000 of taxable income is usually sufficient enough where they're going to save more in self-employment tax than taking on the additional costs. Now, it might be $1,000 extra, but look, if your net income is $10,000, $1,000 is 10% of your taxable income. That's a significant number. And of course, then from there, the higher your taxable income, the more it makes sense to take on the headache of paying professionals to kind of do that extra work.
Well, and yeah, obviously at some point too, you'll start generating enough income, if your business is going the right direction, that, some of the liability protections and everything are important too. But are these professional services, I guess, write-offable? So to the extent that we're trying to get rid of the self-employment tax, does, working with all these professionals, even though it does require a little financial outlay, does that then get sort of backed out, or at least some proportion of it backed out of our taxes?
Exactly. All of that's a write-off. So if I had 10,000 going into it and I ended up paying $5,000 in fees over the course of the year, my taxable income is actually only $5,000 at that point. So that, let me just say that, because this comes up a lot. And in case we weren't going to go there, I want to make sure I share this, because too often we find that it seems like CPAs end up working for the government because they're just so afraid of telling the IRS auditor that they're wrong. We certainly aren't flamboyant with the way we approach auditors, but we know that they're usually pretty incompetent human beings when it comes to the tax code. They're not even trained on the tax rules. They're trained on IRS process and procedures. And so it's the CPA's job, in my opinion, to protect the client, who happens to be the one paying your bills, to help them save as much money as possible in taxes. So when it comes to write-offs in general, obviously what we're talking about, those are write-offs, but too often people miss other things that could be written off. So here's the general idea. The tax code uses a bunch of words that doesn't make any sense. Ordinary, necessary, helpful, appropriate. Okay, I can't really use those words to tell myself, is this a business write-off or not? So here's the way I simplify it. Is the money I'm about to spend related to my business in any form, shape, or fashion? If the answer is yes, then it's a write-off. And if it's a write-off, I need to pay that out of my business account. That solidifies and makes it a lot stronger if I do get audited. So I'm like, so obvious expenses, if I buy t-shirts and I sell them, obviously paying the cost for the t-shirt. Most people, that's intuitive to the business owner. But I don't know, what about the magazine subscription that gave you the image that inspired you to create the t-shirt in the first place? That's a write-off. What about traveling somewhere where I'm going to have a company meeting, or maybe I'm going to meet a potential client, or I'm going to meet an existing client, or I'm going to do some research on the area. Maybe I want to expand my business there. That's related to my business. So is it improving me as a business owner? Then that's the mindset I want everyone to realize, that those are appropriate. And you can take all of those as tax deductions, which then lowers your taxable income. You don't get that benefit if you're a W-2 employee. Your W-2 income is your W-2 income. But if you have 1099 income or business income through an S corporation, you need to be thinking this way.
I love that. That's awesome. Can we ask, or I was going to ask just sort of one more related topic, and I don't know, maybe it's a whole nother topic in and of itself. But so based on all this stuff we're talking about, just because I would love to put this to rest, do the rich pay taxes? So, I mean, here we are where, you hear it in the news all the time. Oh, Elon Musk, he's not paying his fair share, all that kind of stuff, right? And so, but what we're describing, or what we're illustrating through what you were just talking about, was, how we're within the laws, or we're using the IRS tax code to make these deductions, right? We're not just not paying taxes, rather we're using their rules to avoid paying extra tax. So, can you put a fork in that, or is it too political a hot button?
No, I can put a fork in this. It might be too political, but I can tell you. I mean, I'm of the opinion that I think they all suck. I don't care what label they give themselves, Republican, Democrat. They're all greedy people. And anyways, so now to answer your question. So rich people pay taxes. Yes, they absolutely do. Is it less than what some people with their philosophies of how they feel like the economy should work? Is it less than what they think? Probably. But we have to understand, and if you actually look at statistics instead of emotionally driven commentary from media organizations that all of them are biased towards one direction or the other. Shocker, right? If we look at actual just statistical numbers, you can't argue with the facts. When taxes get lowered, the revenue to the government increases because business owners are looking for a return on their money. So part of that return is investing in paying people wages. Well, there's a payroll tax that they're paying on that. Here's a fun tax that I don't know if you haven't come across this yet, you'll be really mad when you do. They're called personal property taxes. So my computer, all this stuff is sitting on a desk. I'm sitting in a chair. I paid sales tax when I bought these. Yay, that's another tax that I pay as a business. And now because I'm using it in my business, I get to pay my county an additional tax just because I'm using it in my business. That's personal property tax. So there are so many different versions of taxes that rich people pay as they're running their business. Maybe their income tax is lower, but a lot of times we only hear the stories of the people who, oh, they have $100 million. Look how much revenue they have, and they didn't pay taxes. Well, they took that money. They also borrowed money, put their capital at risk, and ended up spending more of it. They invested in people. They invested in infrastructure, which also gives jobs to people. And because they did that, they don't pay any income tax, but they paid for it in one form or another. And guess what? That's how the economy actually has to move. Like, you have to have money cycling in an economy. And that's what they're doing. They're cycling through it with the hope that at the end of the day, they'll end up having more money than what they invested. But so, yeah, I get really mad when people are like, rich people don't pay taxes. They're paying, and they're doing a lot for the economy. We need to back off a little bit.
Yeah, I agree. Sometimes I feel like they're getting you from every angle, though, and that's kind of frustrating as a small business owner. It seems like sales tax, income tax, this, that. They're just getting you from every way, which way they can. I was wondering, you mentioned a lot of these different loopholes and things that go on. What are some of the more damaging myths that people have about taxes? Like, oh, if I, write off a portion of my house as a personal office, I've heard that's a red flag for an audit, or, stuff like that. There's all sorts of myths about taxes. Can you maybe break down some that people think that are actually really bad to think and assume?
Yeah, let's do two of them. And you already mentioned one, but the home office, and I'll come back to that one. The first myth that I want people to realize is a crap to believe in is just because you get an IRS letter that says you owe money doesn't mean it's true. In our experience, about 85% of those letters are incorrect. And it just takes digging into the client situation, looking at what the IRS letter is actually saying they're doing, and then writing a letter. Sometimes you jump on a phone call if they give you a contact number. But I mean, we're talking about an organization that is, if it were a private company, they would have gone bankrupt and out of business years ago. They're just so disorganized. There's different centers. There's 26 plus centers across the country. They don't talk to each other very good. I mean, they're using a system that's probably 30 or 40 years old. Don't believe the letter. And sometimes it means that you might have to invest in paying a professional a fee to interpret it for you and then tell you how you can fight it. So depending on how much the amount is, you might get a return on that by having someone tell you, actually, this is how you can fight this. It's not true. So, and then the other one is the home office. That is a big one. And what you said is that it's true. If you file the form that the IRS created to say, I have a home office, I want to take a percentage of it, it does increase their computer score. They call it diff. It's a diff score. And when that form is filed, it increases. And so you have a higher chance of being audited. It doesn't guarantee you get audited, but it does increase your chances. Because the IRS rules basically say if you have a home office and you answered a personal phone call or a personal email in that home office space, it's no longer business use only. Therefore, you can't really write off all the stuff. So from our standpoint, we don't ever file the form. We think it's silly. Not to mention, if people really do the math, it's really a terrible tax deduction. A lot of these things that politicians run off of, I'm going to increase your child tax credits and we're going to give you tax breaks for medical and stuff. Like, they end up being terrible deductions that they've just used to get clout for the person who doesn't really want to do their research to realize, oh, wow, they just promised me $100. So with the home office stuff, like, you get a percentage of your mortgage interest, which you can take 100% of anyways if you're itemizing. You get a percentage of your utilities. Okay, great. But how much are your utilities? I mean, $500 a month for a lot of people seems like, yeah, that's probably more than I pay. So I got $6,000 of utility expense, but I can only take maybe say 10% of it. Cool. I just got a $600 tax deduction. That saved me $42 in taxes, all for the chance of increasing my chance of audit. So here's a strategy that I'll share with those who have 1099 income or are small business owners. We call it corporate rent. If you Google the Augusta rule, that's another name for the same strategy. So it's called the Augusta rule because every year in Georgia, there's a gigantic golf tournament called the Masters, and that's in Augusta. And very wealthy individuals live down there. And most tax code was created because rich people paid lobbyists to get a rule in place. That's how it works. And so let's take advantage of it as small business owners. So they were renting out their houses during this 10-day period of the Masters tournament. They're like, how do we not pay income on this? Because it's technically rental income, maybe. So there's a rule that says if you have a property and you rent it out more than 14 days, that makes it a rental property. So I got to claim rental income. Maybe I have rental expenses. Cool. I have rental activity. If it's less than 14 days though, so I can rent something out, say for 12 days, the tax code does not define that as rental income, which means these homeowners in Augusta don't have to claim any of the income they made for renting out their house for 10 days. Well, we can do the same thing as business owners. It's the same tax rule. Your business can rent from you your living space 1 day per month because you want to have a company board meeting. Even if you're the only one there, you can totally do that. Because other companies rent convention centers and hotels, they're writing off that rent expense. I'm doing the same thing. It just so happens that I own the property that I'm renting. So now I get a rent expense on my business side, which reduces my taxable income. And whatever I paid myself, because it's less than 14 days, I don't have to pick it up as rental income. So I basically took a distribution and converted it into a rent expense. There are definitely some rules around it. You want to make sure you document it and have like meeting minutes and things like that. But I mean, we're talking about, for most people, it's a $15,000 increase in rent expense, and it just went to your personal bank account. That is a much better tax deduction than the home office.
Yeah,
Well,
I love that.
and working with someone like you, that right there covers the cost of working with you, probably.
Yeah,
Just a random
we
guess.
actually become a return. Yeah, we actually save them more in taxes than what they pay us on that.
I wanted to have you. Oh, go ahead, Mike.
I was actually going to ask what an actual, like, I do all my taxes myself. I always have. I've used the Free Tax USA. I'm usually W-2 and some 1099 on the side. Most of the 1099 is pretty simple. So I've never actually worked with an accountant, and I'm probably shooting myself in the foot. I probably could save a lot more money if I hired someone like you, but I've always figured it's an expense I don't need. Can you maybe break down what it actually normally costs to hire an accountant to do your taxes for you, and when you should? If you're doing W-2, I don't think it's necessary.
Totally.
It isn't necessary, but
yeah. Now keep in mind, you have a whole scale of pricing. I mean, you have the guy who's doing it on the side, so he's probably not charging as much as he should, which is not your fault. I mean, right? So he might be underpriced, but maybe charges you a couple $100. H&R Block nowadays is probably, if you go to an H&R Block type of company, you're probably, for simple return, $350, $400. But you have firms that charge by the hour and they charge a crazy amount. I mean, so you could definitely be in the tens of thousands depending on what services you offer. I would say our average client is probably paying, and I'll specify our average client's a business owner. So we also do year-end planning as part of the services. And filing the tax return is a compliance component. And quite frankly, monkeys can do that. And soon AI is going to be able to do that. The real value is interpreting the tax code and giving them strategies that they can use and things like that. Our average client is probably paying, $3,500 a year to do the variety of things. But now to answer your other question, if you're W-2, you have a mortgage statement, maybe even like a brokerage account where you're trading some stocks, interest income, things like that, you don't need a professional. There's nothing a tax software is the result you get from that is going to be the same as paying a professional. Now, we do have some clients that they make a decent amount of money, but it is a simple return in that form, right? Maybe their W-2s a couple $100,000. They have for them, they pay the cost because they don't want to deal with the headache. And if you're in a position where it's that big of a nuisance to you, you could consider using a professional just to save yourself the weekends and headaches of, I don't really want to file it myself. But we're not getting them any different result than they could get on TurboTax, other than they're paying the money, they're leveraging their cash to save their personal time. But if you have 1099 income and you're confused or concerned that you are claiming expenses you shouldn't, or that you're not claiming all the expenses you should, it's at least worth a conversation with an accountant. If you end up having a loss, one conversation could help you understand, I can write this off. And now I can basically write off all my 1099 income. Okay. You probably also don't necessarily need a professional. You would just need to know how to file that on your personal return. But if you have taxable income left over after writing off expenses, I mean, that we definitely earn our keep for sure with a lot of individuals. I mean, just with some of the strategies, you just saved $100,000 in taxes. Oh, that's good news.
That's something.
Yeah, not a bad day at the office.
I hate to take us backwards, but I wanted to try and get this just one question in. We were talking earlier about the Augusta rule and this idea of renting your home to yourself, or the whether or not to bother filing as a home office. But I wanted to ask if anything has changed since COVID, since so many people are working from home now. These corporations still get to write off their buildings and all that kind of stuff. So is there anything that's rolling downhill to the people who are working from home?
It's not really that different, because whether I'm actually working from home 5 days a week, or I just have a home office and I ended up using it on weekends, maybe the tax rule is still, it's the same tax rule for the person who has business income. And again, when I say business income, I'm also referring to 1099 income. By definition, if you get a 1099, you are a business owner in the eyes of the tax rules. If you're a W-2 person and you're working from home, there's nothing you can do. It is what it is. Your probably best bet is to approach your company and say, is there any sort of reimbursement that I can get because I needed faster internet or whatever, but unfortunately from a tax standpoint, there isn't anything right now.
What about the other way around? As a business owner, if you've got your people working from home, do their homes or their workspaces become sort of part of your write-offable office expense, so to speak? I mean, because essentially, they're using your office equipment, they're using your tools, even though they are in their private residence, it's essentially an extension of your office.
If you are reimbursing them to use, you have to be from home and you needed to increase, you had to pay more for internet, or you're working from home now, fine, I'll give you some sort of monthly allowance. If you have an actual expense that you're paying them for that use, then that is a definite write-off. But if I just, Susie wants to work from home and she's happier there, but I don't pay her anything, I don't get to claim as the business owner any percentage of her actual expenses that she claims.
Okay. Can you maybe I have a lot of equipment assets. So like speakers, lighting, all sorts of stuff that I use for doing events. Can you maybe break down how you should write those off, and how it works for someone who just buys a new laptop, for example? How should they can't write it off as a whole lump sum, right?
Yeah, let's talk about it. So the tax code refers to this as depreciation, which is a fancy way to say you don't get all the expense in 1 year. I'm sure there's some actual history behind the word depreciation. So I kind of made that up tongue in cheek because I think the government uses words that don't make sense to any of us sometimes on purpose. Anyway, so yeah, if I buy an asset, which by definition means will have value for more than the current year, the tax code says I have to claim it as an asset. Assets are not expenses. We're talking about two different financial statements. It's the difference between your profit and loss and a balance sheet. Assets go on the balance sheet. So if I buy a $2,000 laptop, I don't have a laptop expense on my profit and loss statement. I have a laptop category on my asset section. Now, that being said, for most small business owners, at least for the last decade plus, there has been what's been known as Section 179 or bonus depreciation. Those are two tax rules that allow me, even though I'm claiming a $2,000 laptop, I can take the full cost of that asset as a tax write-off in the year that I buy it. Because as long as you're under it, the rules have changed. It was $250,000 for a little bit, then it was $500,000. It might even be more, $1 million plus now. But as long as you're under that number of total assets that I've purchased, which all of our clients have been, we can take that tax election to say, I want the full write-off right now. It also happens to be the exact same rules that apply to vehicles that weigh more than 6,000 pounds. So let's say I feel like this truck is needed. It's an $80,000 truck, and I write it off as a business asset and document how I'm using it for business. I can claim the full $80,000 purchase of that vehicle the year I buy it, even if I got a car loan on it.
Okay. So if that's interesting, I didn't realize you could do that with the car loan. That's pretty cool. So say, for example, a business owed $100,000 in taxes, that might be a good time to buy a new truck. That's what you're saying.
Yeah.
Okay, well, that's cool. How does that work with gyms? All of their equipment is essentially that, right? So
Exactly.
would it be better for them to write it off in a lump sum or depreciate it over time? Is there any advantage to doing it one way or the other?
Well, so when you put the equipment into use, so usually the year that you buy it, you have to choose how you're going to handle it. So if I expense all of it now, I've taken my tax break. If I say I'm not going to expense it all now, then I follow normal depreciation rules. And equipment, like the IRS has stupid categories. So like equipment falls into the 5 to 7 year category. So I basically would be able to expense it, say, over 5 years. And I might not need it this year, but maybe next year I would prefer to take all of it. In general, most people are taking the full expense when they can, because if you end up having a loss on your personal tax return, it does carry forward to the next year. Like I got a guy, he's a trucking client. And I mean, he's buying $500,000 worth of trucks every single year. And so like he typically runs at a loss from a tax standpoint, because he's purchasing all these trucks, even though cash flow wise, he's got them on loans. Yeah. So with gym owners, though, to go back to that, their barbells, their equipment, their rowers, their bikes, whatever, usually you claim it as an asset, but you're taking the tax deduction in that same year. Even if you're financing it, most gym owners finance that purchase with some, 5 to 10 year loan.
Cool.
Okay. You mentioned in there cash flow. Do you mind if we sort of do a little gear shift and start talking about cash flow? I think for so many small business owners, entrepreneurs, people like that, they, tend to live in sort of this feast famine cycle, which makes it really difficult to actually cash flow. And so I wondered if you talk about just, first of all, what cash flow is, and then how, those of us that are small business owners could hope to achieve it.
When I think about cash flow, the way I think about it is cash comes into my business because customers paid me for a service, and then cash flows out because I have expenses. I'm hoping the money left over gives me cash flow. Right. I hope there's something left over. Therefore, I have a flow to my cash. Let me use the example. I talked about this. I worked for this company, $30 million in revenue, declared bankruptcy, literally because they mismanaged cash flow. So we have a behavioral thing that a guy classified as Parkinson's law. And what it says is the demand for something expands to match the supply. So it's kind of opposite of supply demand theory. The way we think about this from a financial standpoint is, as a business owner, most have one business bank account. Think of the money in that bank account as a pile of supply. The demand to spend it will continue to increase until I no longer have cash in the supply to spend. And so with one bank account, that's usually what happens. That's why it's feast or famine. I got a bunch of, oh my gosh, we just killed this last deal. We got a bunch of revenue that came in. Look at all this money in the bank account. And I now spend it all. And now all of a sudden, I don't have any cash left to spend. And my next big thing that's going to come in is it's a little bit out. All because of Parkinson's law. So with our cash flow stuff that we talk about, we want to create a false reality that we have less money to spend than we really do. Because the truth is, if I have, say, 10 grand that hits my bank account, that 10 grand is not all mine. If I have team, I've committed to paying them already. If I have a space, I've committed to paying my landlord. Supplies, maybe I need like that 10 grand to actually cost me $3,000. So I need to save that 3,000 so I can buy another 3,000 to sell another 10,000, if that makes sense. And then of course, we don't love it. And with people like me and our firm, we can lower it. But if you're successful, you're going to pay some form of tax. And so I need to at least separate some of that from the 10,000. So that's with the system that we talk about, regardless if you're a gym or service-based or even manufacturing, we recommend setting up additional bank accounts. And those bank accounts will have specific purposes. Like one, making sure I pay myself as the owner. Too often business owners don't do that appropriately. And then they get burnout. And we want to avoid burnout because not everyone in the world is willing to take on the risk of owning a business. You're also taking on the risk because of the risk of being a business owner. You should be giving yourself profit distributions, just like these stocks you can invest in that pay you dividends. Your business should pay you dividends. You're going to owe tax. Let's set aside that money. If you have team, like for me, our team is a large expense. So I set aside that money as well. So by setting it aside in these separate bank accounts, I've now kind of put boundaries around my cash flow. So now when I look at my operating expense account and say there's 6,000 left out of the 10, I'm very comfortable to totally spend that full 6,000 because I've already isolated my other commitments. Now I don't have to deal with a feast or famine scenario. I've built up a buffer. I've given myself protection. And when these other bigger expenses come that I've identified, I got the cash available because I've already set it aside.
Is the separate bank accounts more of a psychological thing to keep you from spending it? Or is it an actual, is there a reason behind having them in separate accounts? I guess is what I'm asking.
I'm not a psychiatrist, so I can't totally answer it. But I can tell you based on our experience with hundreds of clients running this, yeah, there's something about it. Because we've had some, it's like, I'm just going to track it on an Excel file. And I'm still going to use my one bank account, but I've identified how much is for what. They always screw it up and spend the money that they shouldn't have. And then tax bill comes like, I don't know where this money is. How am I going to ever pay this? Well, your Excel file said you should have had 10 grand available to spend and you,
right.
you have $2 to spend. Yeah. So, I mean, my experience says there's something about it that does help people stay in control of their money, but I don't know the real reasoning behind it. I mean, ultimately it's kind of the envelope system that we might have heard from our grandparents. It's just we're using business bank accounts instead. And, they worked back then for those people in the Depression when it started, and it really works for the business owners now. Yeah.
Yeah, I love
So
that.
when you get an initial cash influx of 10 grand, say for example, you just tell your clients, all right, 10% goes here, 5% goes here. Do you, is it like an automated system that you set up for them, or how does that work?
It is. And the percentages will vary based on the client and what they have going on. But yeah, the first step we do is we assess their business and come up with what the percentages should be, so they don't have to think about it. And the reason percentages make the most sense is because, let's say I'm used to $10,000 in deposits, but maybe I ended up getting 50 grand in a deposit, like, whoa, how does that change things? It doesn't. It's the same percentage. Just use the same percentage, and it just really works. I mean, as a testimonial, all of our gym owner clients who were running the Profit First system before COVID forced them to close. Most people may not realize, but the government forced all gyms to close.
That happened to me.
They all survived. All of our clients who were running Profit First and this cash flow management system before COVID happened. I'm not saying it was easy, but they survived and had enough cash so that they could see the other end and now start getting revenue again. Like, the system works. Sometimes I don't know exactly why, but I just know it does.
Yeah, I think that's a much more eloquent way of putting it. I always just use sort of the goldfish analogy that we always grow to the size of our bowl. So it's kind of an idiot's guide to that same Parkinson's principle. But the idea is just, if we have it, you see it with people who start making more money all of a sudden, right? All of a sudden they run out and they get more expenses, so
Right.
it's kind of the cycle that continues to grow. And so I blame goldfish for just about everything. I wondered if we could talk about, you sort of touched on quickly, but I wonder if we could dig in a little bit on the topic of burnout and what that looks like. I think that, cash flow is obviously one of those things, right? If you're in this feast and famine mode all the time, whenever you're on famine, you're probably not feeling real hot, but you need to be, as hot as possible because you got to make that money. And so I wonder if you'd talk a little bit about just sort of the phenomenon of burnout in sort of your entrepreneurial clients and what you're doing to help people stop.
Yeah, all of us have this switch that happens sooner for others and later for others. But if something is hard enough for long enough, we will eventually ask ourselves, why am I doing this? And for business owners, that happens over the course of the experience of, I'm working my tail off. I'm probably putting in 60 to 80 hours a week. I'm living paycheck to paycheck. I don't even know if I can pay myself or put food on the table, like, because they're constantly paying expenses or paying their other team. At some point, they will hit that spot where it's like, I am so exhausted from this effort because I have nothing to show for it. Like, investing in things long-term is great, but we all need confirmation back that it's doing good. And we can only help other people for so long before we realize we actually should have helped ourselves first, to put ourselves in the position of power to truly help other people. And so that's what happens. Like, it could be 2 years, it could be 3 years with gym owners. I mean, these guys, because of their discipline with exercise, they can go years, sometimes 5, 6, just falling on the sword and not paying themselves anything. But everyone hits that wall at some point. And when you hit that wall, it goes down fast. It crumbles fast. And so in a short amount of time, the people they were trying to help are no longer getting service anymore because they're like, I'm done. I'm out. I'm selling it. I'm closing the doors. This literally isn't worth it. I can go to McDonald's now and get $20 an hour and have zero stress than what I'm doing with now. And so that's how I've seen burnout kind of play in the entrepreneurial space. And this is why I love the Profit First system. By definition, profit first, we're saying take your profit first. And I made a little joke in my book. So Mike Michalowicz wrote the original concept, profit first. And then people like me have written how that methodology works with specific industries. And I said, I think Mike would have preferred to call it cash for the benefit of the owner first, but darn it, that's just not as sexy as the profit first, But ultimately, that's what the system is. It's, let's make sure the most important person in the business who has the vision and the passion to keep it going is taking care of themselves enough so that if they ever choose to stop doing it, it's not because they burnt out. It's not because they don't have the cash to do it anymore. And so that's what the profit first system is. It's designed to make sure the owner pays themselves what they should be paying themselves. And sometimes that means they got to take a pay decrease because they're bilking their company for more money than it can afford to pay them. But a lot of times with gym owners, it's like, dude, you got to pay yourself something. Setting aside money for tax, that's a pay increase, because for most of us, before a system like this, if I took home 10 grand, I got to pay income tax on, like, I got to take some of that out because I'm going to end up paying income tax. We say, no, as a business owner, if you're taking home 10 grand, live off the 10 grand. The business will set aside an additional percentage of the income so that come tax time, it's going to give you a distribution and cover your income tax for you. And then the profit distributions, most owners don't have a conscious system of giving themselves quarterly distributions just because they're taking the risk for owning the business. They should be. And that's fun money, because that gives us a psychological edge. It's like, I don't have to live off this money. In fact, we don't want them to. They need to be living off of the normal monthly paycheck they're taking, or, or distributions. The profit distributions is pure, like, I don't have to live off of this because I have all my household expenses covered. What am I going to do? Family trip. My whole backyard is evidence. We could go around each year and see like what my wife asked me to use our profit distributions on, the pool, the play set, the basketball hoop, those types of things. All of it's geared towards keeping the business owner interested in keeping his business going. And if that happens, they don't burn out.
Yeah, no, I really like that, especially like as it pertains to investing. All the big gurus use a version of this, right? This idea, pay yourself first, right? Which is, I guess the W-2 version of this, right? This is the, the Tony Robbins and the Dave Ramseys and stuff will tell you something like that, pay yourself first. But this is actually the first time I've heard it put in this sort of business-centric way, where ultimately, yes, you are paying yourself first, but basically you're withdrawing that profit before you spend it, back to our Parkinson's law discussion.
Right. Yeah.
So you've mentioned, a few different ways that someone can pay themselves as a contractor, someone that's self-employed. I'm sure that a lot of people do it wrong. I'm probably guilty of that myself. Can you maybe break down the right way and the wrong way to actually pay yourself as an employee or as the business owner?
Yeah. So if you're an S Corp owner, you are also a W-2 of your own business. And if you're not, you need to talk to an accountant because you're going to get in trouble with the IRS. So let's say there's 50 grand in the account and I want to pay myself, but I want to do it in a way that doesn't increase taxes unnecessarily. The second lowest hanging fruit that we find with S corporation owners is they actually are paying themselves too much in a W-2. The tax code says the amount just has to be reasonable. There's no formula, there's no math, there's no numbers. Here's reasonable. And then over the years, court cases have kind of give us some like categories and ways to analyze reasonable. But so if I got 50 grand, 20 grand probably is reasonable. So, okay, I'm going to run 20 grand through my payroll. So I have to pay payroll tax on that. That hits me. Well, I have this other cash. I still need the other 30 grand. Corporate rent. I look at that. That's an owner's pay type of concept. So that's another way I pay myself, is I'm paying myself a rent fee. And then distributions, which is simply a transfer from my business account to my personal account. And it's, if you're doing your own bookkeeping, it's called an equity transaction. It's an owner distribution. Those are the three common ways that an owner in any given month is going to have all three of those depositing money into their account. As far as like, I think you asked how W-2 people should pay themselves. I mean, they don't really get a say, right?
Yeah.
They're W-2s, they're W-2. And then using something like pay yourself, the richest man in Babylon concepts, I think are really great. If you're a straight W-2 earner.
Yeah, I have, with the combination of both, sometimes I'm actually paying the business to fund the business. Like my W-2 income sometimes is going into my business account. Yeah. So it's kind of funny.
Yeah. And when that happens, honestly, that's a sign that your W-2 might be too high, Because like if my business ran at a loss, and then I get audited, they're going to be like, why didn't you pay yourself a wage? Well, what business owner is going to pay themselves when they personally are putting money into the company just to cover expenses?
Yeah.
And so the trouble people get into with the IRS is when they take distributions and don't claim any wages. And so it's just having an accountant to help you walk through and understand those different dynamics of your situation helps, because if it's going through W-2, you've paid payroll tax on that.
Yeah.
And so we want to avoid that if we can.
Well, John, it's about that time. Thank you so much for making time for us. I really enjoyed the conversation. It's always interesting when we have an accountant or a tax professional, because I always learn a ton. Can you maybe tell our listeners where they can reach out to contact you and maybe find your books if they're interested?
Yeah, so the book is Profit First for Micro Gyms. We have the URL profitfirstformicrogyms.com. You can buy it on Amazon. I think Barnes and Noble and Target, like their online stores, it's there as well. Our website, like what I've talked about here, we have gone into much further detail on everything that we've talked about, plus some in our blogs. And so if you're looking for some tax strategy ideas, go to insighttax.com. And it's spelled a little bit different because it's insight as into cause to action, usually used to cause riots because we don't like the government. So it fits our personality. So INCITETAX.com. And if your audience wants, we've talked about cash flow. One of the first things we do with clients who want cash flow help is we analyze their expenses. And so I have a whole chapter on it in my book, but we've turned it into just a quick one pager. So there's 9 questions you can ask about every expense. And it does get monotonous. But if you ask all those 9 questions, by the end, you know if that's really an expense that's serving your business or not serving your business. And so if they want that and maybe some other free handouts, they can go to insighttax.com/wealth. And they can get that handout there if they want.
Now, do they have to live in Utah? Anyone in the States can hit you up, or is that for?
Yeah, we serve all United States taxpayers. We do bookkeeping for some gyms that are outside of the US, but from a tax standpoint, we only do US tax. But anywhere, okay. Yep.
Cool.
Awesome. Well, thank you so much. We, like Mike said, we totally appreciate you coming on. I mean, I've been paying taxes as a small business owner for a lot of years, and I still don't think I ever quite get it right. So I really appreciate you taking the time, John, to sort of break down some of these topics. They're all especially relevant to me. So yeah. I appreciate it.
You're welcome, and I appreciate you guys having me. Thank you.
Absolutely. And thanks so much to everybody who tunes into the show this week and every week, and we'll see you all next time.